Hello, good morning to all and happy Friday. This is Kelvin here again. Welcome to today's Daily Dose of Market Insights, and today will be Friday, the 3rd of May, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right. So leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook on the major stock indices, the major FX pair, the two key commodities that I tend to share on a daily basis, which is spot gold XAU/USD and West Texas crude oil, let's have a recap of what are the key events that unfolded yesterday in terms of their impact on the cross asset classes. So firstly, yesterday markets actually rallied, the stock market actually rallied in the US session, but not so much on the European currency, pretty much still sideways for the German DAX, if you were to look at that as a proxy for the major European stock indices, because the German DAX still remains below the 20-day moving average and being trapped as a very tight sideways range between I think less than a 1% range. All right, but however, what happened yesterday was there is a stunning reversal, I would say intraday bullish reversal on the major US stock indices. If you could look at my screen over here, let me share with you guys. We see across the board bullish reversal between 0.9% to 1.8%. So the one that is gaining the most is the Russell 2000, up 1.8%, the Dow Jones up 0.85%, the Nasdaq 1.3%, and the S&P 0.91%. All in all, a very strong recovery ex-post FOMC. So what you see over here is during the ex-post FOMC press conference, right after Powell speak finished the day before, which was on Wednesday, early Singapore time, Thursday, the market actually sold off. And yesterday, the market rallied throughout the entire session. So this is the entire session over here. It dipped down first, then thereafter it just pushed higher and higher. So it actually kind of retested yesterday's low, the prior day intraday. Okay, so if you look at the chart, this is what I mean. You look at the S&P over here. Okay, so this is what happened. All right. Okay, so this was initially the price action push up. Powell talk after Powell speak finish, rejected off the 20-day moving average. It went down again. Okay, so yesterday's intraday, it managed to actually retest yesterday low before shaping another rally, and now during the Asia session, it's actually testing the 20-day moving average based on the futures pricing. All right, so all in all, right, what we could see is a rather volatile session yesterday. Okay, it's a big swinger, volatile session. Has the trend changed in terms of the trend? We call it using technical analysis, because price action is still below the 20-day moving average and below the 50-day moving average. So for sure, we cannot be sure that this is a clear movement of a uptrend. And also, if you look at this is the daily chart of the S&P, using the S&P as a proxy of the US stock market, given that it's a number one, is being internationally watched market as well, and lots of, we call it institutional players, is actually using S&P also as a gauge to actually monitor the health of the US stock market. So if you look at it over here, it's also still below this trend line resistance that is also very close to the 50-day moving average. Okay, if you look at it over here, this could be the make or break level. Okay, graphically, it's a zone. Okay, it could be a make or break level, 5120, 5150. So unless this 5146, you round up 5150, break up from this line here, this zone, this red zone, this key resistance zone, then we can be more or less be much more have higher odds that the trend has reversed to actually kickstart a new impulsive up move, potentially to seek new all-time high on the US stock market using the S&P as a proxy. So yesterday's volatile movement hasn't changed the current short-term downtrend scenario that could still be intact on the US stock indices. Okay, by taking so what causes yesterday's volatile movement was actually a push now in the US 10-year Treasury yield. So those who actually follow our daily dose, US 10-year Treasury yield is actually a very key component in terms of doing intermarket analysis. Why? Because it impacts the FX market, it also impacts the stock market. So for the stock market, is through the conduit of long-term cost of funding. So the US 10-year Treasury yield is being viewed as a proxy of risk-free rate. So you know that any corporates or for example corporates who borrowed long term, the bank will charge them the US 10-year Treasury yield plus certain percentage above the 10-year Treasury yield based on their credit standing of the corporate that's borrowing the money from the bank. So if the US 10-year Treasury keep on increasing on the upside, which it did in the last 3 to 4 weeks, that causes that initial plunge of the stock market on the 12th of April, which was not too long ago, about 3 weeks ago, due to the very steep move on the steep short-term rise on the US 10-year Treasury yield, breaking above 4.5%. That increases the trajectory of the US 10-year Treasury yield, which in turn lead to a potential higher cost of funding environment, which eventually will also squeeze net profit margin of corporation. So that actually explains that fall on the initial US stock prices. Then thereafter, we see that US 10-year Treasury yield going sideways. Right. So yesterday's price action of the US 10-year Treasury yield. So if you were to look at it from this perspective, let me share with you all. Okay. So what we could see over here is that at this point in time, after hitting the high on 25th of April, in the last 1 week or so, it started to consolidate and did that pullback. All right, but it still hasn't broke below that 4.5% level yet. That was taken out. Yes, taken out decisively on the 11th of April. Okay, so that actually explained 11th of April, it break out. And if you look at it over here, then thereafter 12th of April, the price action starts to be bearish on the S&P 500. Only when the S&P 500 start to rebound, it rebounded from 22nd of April, then it traded sideways, very volatile. So if you look at, you put in parallel, you see the direct opposite movement. So on the 25th of April, this is where the 10-year US Treasury starts to shape that pullback. All right, very interestingly. So this pullback over here is still holding above the 4.5% level. So if you put in the 20-day moving average, it's actually testing right now. All right. So what we see over here is that the 20-day moving average is acting as a support on the US 10-year Treasury yield, while on the reverse, the 20-day moving average is acting as a resistance right now as a key intermediate resistance right now on the US S&P 500. So you notice that very strong indirect correlation between the 10-year Treasury yield, the movement of the 10-year Treasury yield, and the movement on the SPX 500. So as long as this give or take this 4.5% level continue to host on the US 10-year Treasury yield, potentially we could still continue to see some form of short-term downside pressure on the S&P 500. Because why? The trajectory, the trend, the short-term trend of the 10-year US Treasury yield is still pretty much intact, and also is still also holding above the 200-day moving average. And if you put in the 50-day moving average, it's just slightly above that 4.3% support level. Okay, let me put in the 50 moving average for you guys to see. Okay, very quickly. Okay, put it there. So okay, it's just slightly above the 200-day moving average, which is at the key support at 4.3. So overall, what I could see is that short-term uptrend and medium-term uptrend is still intact on the US 10-year Treasury yield. So overall, as long as it didn't break below that 4.3% level, in the medium term perspective, there could still be further potential downside on the US stock market, given the fact that the trajectory of the 10-year US Treasury yield is still pointing up. So yes, for sure, intraday, there will be a lot of wild swing between the minor intraday movement. That particular push down in the US 10-year Treasury yield also kind of supports this weakness on the FX market. All right, so the weakness on the FX market is being seen on the dollar index that is being currently being pushed down below the 20-day moving average, but is still holding above the 50 and the 200-day moving average. All right, very similar movement like we'll see in the 10-year Treasury yield in lockstep. It is moving in lockstep with the 10-year Treasury yield. Yeah. So like I say, if the 10-year Treasury yield keep going upwards, it actually supports a stronger US dollar, using the dollar index as a proxy in the FX market to determine dollar strength. So as long as this 104, okay, what's this resistance level? 104.20 didn't break down on the downside, the medium-term uptrend is still intact on the US dollar index. But short term, we may see a bit of sideways movement. Why? And also do not forget over here is that the Japanese authorities are actually watching the dollar yen market. So there's also a lot of fear that is rising this FX market, where the yen strength, the yen kind of short-term yen strength will be back into the picture because of potential FX potential further FX intervention coming into the FX market. That could also be one of the factor that is putting dollar strength on cap as well. All right, because of this very complicated move in the FX market right now. Okay, so what we could see over here is, if you look at the FX market situation, the heat map of the FX market, I share your, let me share, yeah, this is the heat map. Okay, so this is the 5-day rolling performance of the major currency as of now we are speaking. So what we could see over here is that the drag of the dollar yen. So this is dollar yen, okay, dollar yen over here in this dark blue line. So you see that dollar strength deflating against the yen has started to drag down against the rest of the major pair as well. All right, so net overall, what we could see over here is a very throughout short term dollar strength dissipating, or dollar strength decline against the major currency that is being more or less kind of being triggered by that intervention from that Japanese authorities in a couple on Monday, and potentially also rumored. Actually, they are not confirmed. All these are just based on looking at the anecdotal evidence from BOJ. We call it data releases on their holdings, on their holdings. And the media actually speculated there's high chance that BOJ actually intervened on this Monday, which causes this little plummet, slide down, and as well as during the 10-hour trading session after the close, right at the close of the US session on Wednesday, means early Singapore time, Thursday. All right, okay, early Singapore time, Thursday, that means we're talking about 4 a.m. Singapore time, Thursday. That's the second plunge. And yesterday, the market plummeted down again. So right now over here, there's also ongoing rumor that BOJ or MOF is still watching the market as well. Then it kind of create a very kind of fearful negative feedback loop into the dollar yen, that actually this is what the authorities wanted to prevent further potential upside on the dollar against the yen. All right, so do not forget over here also later tonight there will be also a key important data, which is the US non-farm payroll. So by engineering the dollar yen at such a low level, any potential very strong non-farm payroll data, any spike up, right, it would not actually lead to a very strong push up to break above the key 160 level mark that they are watching. All right, so now, but for sure, later we share with you this ongoing movement that is taking shape right now is actually causing a drag on the dollar strength against in the FX market, at least in the short term. And we know that dollar strength is actually sometimes viewed as a opposite flip side of the coin with gold price. So gold price managed to actually stop its pullback that took shape at the early part of this week, where XAU slash USD broke below the psychological 2030 level. So later I'll flash the short-term technical outlook on that. So also with that particular pullback in the US 10-year Treasury yield, that also support a kind of a short-term consolidation or more or less recovery bias potentially on gold, because the cost of holding gold now has starts to consolidate instead of keep on increasing higher, the opportunity cost. All right, so with that, right, that actually sum up the intermarket linkage across the board yesterday. And also right, today's Asia session, the major US stock indices rallied as well, continue to, if you look at the Nasdaq 100, continue to add 0.6%. Okay, 0.6% due to Apple earnings result that was releases after the close of yesterday US session. So Apple actually reported better performance in China than initially feared. So Apple share jumped close to 6%. So even though the revenue fell to 4.3% to 90.8 billion in the March quarter, that's the total revenue. But net it's slightly better than market expecting. All right, at 90.3 billion, just a slight uptick. All right, so overall here, and also Apple managed to actually plan a 110 billion stock buyback program that also support their stock price. All right, so the stock price in the after hours session actually rallied further by 6%. So this was the close of the US session. So if you look at the close of the US session, Apple already rallied by 2.2%. So during the after hours, it continued to push up higher by another 6% or so. All right, so that actually create a bit of a negative positive feedback loop during the Asia session on the Asia stock market. But later I will share with you all on the short-term technical outlook. Some of the Asia major stock indices at the Hong Kong 33 is approaching a short-term resistance right early today, this morning session, because of that push up, the spike up in due to the Apple's better than expected earnings. And why Apple is important? Because Apple is the second biggest weighted cap stock inside the S&P 500 and the Nasdaq 100. All right. So now with that, let us now jump straight to the short-term technical outlook. So let us start with the major indices first. All right. So let us start with the Asia. Okay. So this is Hong Kong 33. So Hong Kong 33. Okay. Oops. Sorry, where's this? Yeah, Hong Kong 33 over here. Okay. Now with that, let me expand my screen so that you guys could see. Okay. So yeah, this is Hong Kong 33. So this is the early morning spike up. Okay, it spike up over here. So after that spike up, right, during okay, this was the US session spike up, in line with the major US stock indices. And what interesting over here, the way it react off, there is actually a pullback already taking shape. And where does it pull back? It pull back at the top of this minor ascending channel that I drew, and also above that resistance level. So yesterday we were neutral between this 8,050, then 8,500 breaks, it will potentially seize the next resistance coming in at 8,800 level, which is more or less is almost hit that level, because yesterday's US session high was 18,660. So this 18,800 level is actually this very clear graphical minor congestion area. Okay, it hit this level now, also top of the channel, ascending channel, and with that RSI now coming down, and after hitting a relatively extreme overbought level, all right, and it's now exit from the overbought level, overbought zone, I would say deep down below 70. So there is potentially a chance for at least a short-term pullback scenario to unfold in this ongoing short-term uptrend that is still intact. All right, so for a very short-term bias, trend bias for today, it will be a potential short-term pullback scenario unfolding. That means a short-term bearish bias pullback scenario to unfold within its short-term uptrend that is still intact. Why? Because it's still trading above the 20, 50, and it just clear above the 200-day moving average. But in the short term, potentially there could be pullback, at least 18,800 short-term pivotal resistance holds. Support level to watch 18,000/17,900. If we see an hourly close later today at 18,800, then this pullback scenario will be invalidated to see the continuation of this impulsive upmove sequence within its short-term uptrend phase, for the next resistance to come in at 19,390, followed by 19,980. So 19,390 is the 1.382 Fibo extension, and also confluence with this higher level minor congestion area from 2nd of August to 11th of August. Okay, so that's for the Hong Kong 33 index, or the Hang Seng index, potentially due for a potential minor pullback scenario to unfold. The Nikkei 225 or the Japan 225. So the Japan stock market is actually closed today for a public holiday, so we don't see much action, trading sideways. So still no change is being trapped between the 20-day moving average that can't break up, and also this near-term support at 37,680. So I'll be still using 38,800 as my short-term pivotal resistance level. So this 38,800 graphically is this former minor swing low turns into a pullback resistance, and as well as the descending trend line that I drew from the high of 21st of March. Okay, so as long as this 38,800 short-term pivotal resistance holds, potentially there could be still a bit of minor downside scenario to unfold within this kind of a very complex sideways range configuration. It got a break below 37,680 to expose the next support level at 37,070. Only an hourly close above 38,800 invalidate the short-term bearish bias scenario within its complex sideways range to unfold another leg of counter trend rebound scenario. Next resistance to watch will be at 39,130, followed by 39,480 on the Japan 225. Then the German 30, so this is what happened in German 30. So I did mention that the German 30 during the European session, where actually it still has some, it overlapped with the US trading session at the opening, on the opening first 2 hour US session. The German 30 didn't actually shape much rally because it didn't even break above yesterday's high and still trapped between the 50-day moving average and the 20-day moving average, okay, over here. Okay, so it's like very tight sideways range, but price action still seems to be can't breaking above the 20-day moving average, which is acting as a first resistance at 18,060 level. Okay, so no change. We still maintain that short-term bearish bias on the German 30 index, which is the DAX, but I don't put it so tight at 1860. Still using 18,150 as my short-term pivotal resistance level. First support level to watch will be at 17,900, 17,840 for today. Okay, this level, unless this level breaks down, then that potential decline will be potentially much more pronounced to retest the 19th of April swing low at 17,550. However, the hourly close above 18,150 will invalidate this short-term bearish bias to see a potential squeeze up to retest this medium-term swing high area of 24th of April and 29th of April at 18,310, and above it sees 18,400/18,490. US indices. So this is the strong push up of the US indices yesterday. The Dow Jones Industrial Average, US Wall Street 30, it came down, retested exposed Fed Chair Powell press conference where there was a sell-off, hit that intraday low during the end of the press conference over here before then thereafter rebounding throughout the US session. And what you see over here is that there's actually some form of hesitation by the bearish hourly candle at the close of the US session. Okay, at the start of the Asia session, pardon me, at the start of the Asia session over here at 6 a.m. Singapore time, it shows this hourly shooting star right below the 38,590 short-term pivotal resistance that we highlighted earlier. So with that, right, still no change. We still maintain that short-term bearish bias. So it seems to me that it's been hovering around in this kind of complex sideways range as well in the short term. So as long as 38,590 short-term pivotal resistance is not surpassed to the upside, potentially it could mean revert down back towards the bottom of the range again. All right, first support level to watch will be yesterday's minor swing low that led to that fast and furious strong intraday rebound. 38,020, a break below 38,020 exposes the minor swing low area of 25th of April and 1st of May that is acting as a next resistance, next support level at 37,750. All right, so these are the two support level to watch within this range configuration. However, if we start to see an hourly close above 38,590, then this bearish bias within range configuration will be invalidated to see another leg of counter trend rebound scenario to unfold. Next resistance level to watch will be at 39,050 level. Okay, so 39,050 level is the minor swing high area of 5th of April and 10th of April. And if we were to do that Fibo retracement over here, okay, this Fibo retracement, if you take into account all the way down towards this level here, is also close to that what I call it, this golden ratio of 61.8 retracement. All right. Now, next up will be on the Nasdaq 100. So very similar on the Nasdaq 100 as well. So this is the 20 and the 50-day moving average. So price action managed to actually cap at the 20-day moving average despite today's very strong reaction up, move up from Apple. So it actually didn't clear above the 20-day moving average, which was the resistance for yesterday as well, 17,720. So using 17,720 as my short-term pivotal resistance, potentially there could be a chance of a mean reversion back towards the bottom of this range. The first support level to watch will be at 17,390, which also confluence with the yesterday's minor swing low that led to that strong push up, right? However, a breakup above 17,720 will invalidate this short-term bearish bias to see the continuation of another leg of counter trend rebound that has taken shape since the low of 2 Fridays ago, 19th of April. Next resistance to watch will be at the 50-day moving average and the top of this minor ascending channel, confluencing at 17,890 / 17,965. Okay, so that's pretty much sum up for the major stock indices. So all of them, yep, despite the US stock market rallying, they are still right at their respective short-term pivotal resistance level, and potentially they could be due to some form of bearish mean reversion. Okay, now with that, let us immediately go to the FX market. So FX market over here, let's start from the Asia side of the story. So what we could see over here is that dollar yen. So dollar yen yesterday, initially it bounced off from the 20-day moving average. Then since the bounce off the moving average, we do have a short-term bullish bias, hoping it to recapture back the swing high area of 1st of May. But during the US session and the European session, it traded lower and broke below that 20-day moving average as well. So given the break of this 20-day moving average, potentially we could see this form of minor we call it a corrective decline phase continue to unfold. All right, as we're going to trade within this minor descending channel, okay, that has started to take form. Okay, so what we could see is the bottom of that channel actually confluence with the 50-day moving average at 1516, which is this graphical support area here, and 150.60, 150.80, which is another graphical support, this minor swing low of 5th of April. Okay, so this is the two support zone to watch out for this potential corrective decline to unfold. So right now, the key thing is where will be the short-term pivotal resistance to actually maintain this potential corrective decline sequence that is still unfolding in the dollar yen. It will be at 15610 for sure. Why? Because 15610 confluence with yesterday's minor swing high that led to this lower low that is being taken shape during the European session and the US session, and as well as this upper limit of this minor descending channel that I drew. Okay, so potentially if you look at the RSI right now, the RSI right now at this point in time is actually shaping a kind of bullish divergence. So at this level here, because the current price action is retesting this long tail here at this point in time, there could be a chance of a rebound close towards the 20-day moving average at 154.25 area. This area here, 154.25. So I don't want to put it so tight, 154.25 as my short-term pivotal resistance, because at the end of the day, right, it could squeeze even higher given that there is a non-farm payroll data that is out later today. So as long as this potential rebound didn't surpass 15610 for today, the medium, not say the medium, the minor corrective decline sequence is still intact on the dollar yen. All right, so then the next support level to watch within this minor decline sequence that is ongoing will be 15160, 15080, like I explained earlier. Unless there's an hourly close today at 156010, that means the potential rebound has already been overextended and broke above this minor descending trend line channel and the pivotal resistance at 15610, then this minor corrective decline sequence will be invalidated to expose the next resistance at 15790. And for sure, the key pivotal resistance over here will be at 15960/16030, where this is kind of a land in the sand that is being kind of indirectly detected by the Ministry of Finance of Japan, where they actually more likely high chance that they rumored intervene on the FX market on Monday to prevent the yen from weakening further against the dollar. Okay, so that's pretty sum up on the dollar yen. So the Aussie dollar, another very messy currency right now, movement in terms of the move. So it's, if you look at the daily the 4-hour chart, right, or the daily, let's put at the daily chart, easier to see. Okay, so if you look at the daily chart, okay, maybe what I can do is, okay, let me share with you the daily chart. Okay, so this will be the daily chart of the Aussie dollar. So I could see over here since 28th of December all the way down towards 19th of April. So in the last 4 months or so, right, it's been trapped inside this sideways range configuration. Okay, that is in place, in fact, in place since 13th of October. Right, you look at 13th of October all the way until now, it's being trapped inside this kind of symmetrical range complex triangle configuration, and the last few days of price action is been trading in the middle of nowhere of this range. So that actually explains the very short-term choppy movement of the Aussie dollar, because there's no clear trend as price start to oscillate between the 20-day and the 50-day moving average, as well as the 200-day moving average. Very wow, right? So yesterday price action, right, has broken above again of this minor trend line resistance that I drew from the 9th of April. Okay, previously it was being trapped, but in this area here, and yesterday it staged a breakout. Today, Asia session, it managed to actually react off the swing high of this Monday at 65.85, come break and starts to come down. And with that, the RSI also starts to exit from its overbought level. So potentially right now, there could be a chance of a minor pullback first. First pullback support level to watch will be around this dotted gray line here, which is the minor descending resistance, then is the pullback support, and this minor congestion area I think as a support level as well at 65.50, but I don't put it so tight. So I will use 65.20 as my pivotal support, which is the 20-day move, 200-day moving average, and that intermediate minor swing high of Thursday, which is yesterday. So as long as this minor pullback didn't breaks below 65.20, there could be another potential we call it a potential rebound, minor rebound to unfold within its medium-term complex sideways range configuration, with the next resistance to watch will be at 66.10, followed by 66.40 level, which is the swing high area of 8th of March and 10th of April. However, an hourly close below 65.20 will invalidate this rebound scenario to see it coming down, float back down towards the bottom of the range again at 64.60, 64.25 will be the next short-term support level to watch. Okay, so that's for the Aussie dollar. Now, the European currency, okay, over here, so the European currency over here will be still trapped within a very sideways range. So the euro dollar yesterday came and hit the first support level that we highlighted at 106.80 before rebounding up in the later part of the US session and retested the short-term pivotal resistance at 107.40. So still no change, still using 107.40 as my short-term pivotal resistance level, and first support level to watch again will be at 1.0680. Unless this 1.0680 breaks, it will expose the next near-term support area as 1.0640 which is also confluencing with the minor ascending trend line that I drew from 17th of April. So it's still trapped within this minor sideways rangy configuration on the euro dollar. Unless we see an hourly close above 1.0740, then it will lead to a potential unfolding of another minor counter trend rebound scenario leg to unfold. Next resistance to watch will be at 1080, which is confluencing with the 200-day and the 50-day moving average acting as a resistance. Above 1.0880, 1.08 exposes 1.0850, which confluence with the medium-term descending channel from 28th of December. Now on the sterling dollar, also very similar. Yesterday price action came down, almost hit the first support level at 12460 before rebounding, and come close to the pivotal resistance again at 12570. So I'll be still using 12570 as my short-term pivotal resistance. We also confluence with the minor descending trend line that I drew from the high of 8th of March. So first support level to watch will be at 1.2460. Again, no change, as it's going to trap within this minor sideways range configuration. All right. Unless we see an hourly close above 1.2570, will invalidate this short-term bearish bias scenario within a short-term range configuration to potentially kickstart another leg of minor counter trend rebound scenario. Next resistance to watch 12640, followed by 12710 on the sterling dollar. So now spot gold. So spot gold, no change as it's going to stage that minor recovery. So I'll be still using 2265 as my short-term pivotal support level. Resistance level got to break will be at 2365, okay, which confluence with this congestion area here, and as well as this descending trend line resistance of this potential descending wedge configuration that is unfolding. Only a break above 2365 potentially sees a much more deeper recovery to retest 2420 in the first step. However, a breakdown below 2265 will invalidate this short-term recovery scenario to expose the next support level at 2035, followed by 2210, which is confluencing with the upward sloping 50-day moving average. Then West Texas crude oil, still no change. Yesterday consolidate sideways. Okay, 74.40 will be my medium-term pivotal support level, which we highlighted yesterday. First resistance zone to watch will be at 80.80, 81.50 level. If you see an hourly close below 78.40, then this recovery scenario will be invalidated to continue to see the extension of this corrective decline scenario to unfold, exposing the next support area at 76.90, followed by 75.50. Right, that's for the West Texas oil or WTI crude oil. Okay, so before we go, key economic data to watch for today. Today will be Friday, for sure will be the all important US non-farm payroll data. Okay, let me go all the way down. Okay, so non-farm payroll data to look out for today. All right, so market is actually expecting a reduction of 243k jobs data that is expecting. So any number that is way below this data potentially explain a softer US job market, and that could actually imply a weaker dollar, because that actually increases the chance of the US Federal Reserve to be more dovish, and that also potentially could see another round of risk on scenario unfolding back into the US stock market, okay, if it goes down below the consensus of 243, way below it. Okay, then the next one will be ISM Services data. So that is very important, well, because that actually indicated the services industry of US, as we know that US is more of a services industry rather than a manufacturing industry. So market is expecting a slight recovery to 52 from 51.4 that is being recorded in the previous month of March. So that will be out at 10 p.m. Singapore time. So with that, that is actually the key data to look out for. And perhaps this one, the market already closes, so not so important. Why? Because we see a slew of Federal Reserve officials speaking in the wee hours of early Singapore time on Saturday at 7:45 a.m. Fed Goolsbee and Fed William was speaking, but that shouldn't impact the market. Why? Because the market really closed for the day. Okay, so yeah. So with that, that pretty much sum up for today's daily dose of market insight. So I wish you all a great day ahead and do have a restful weekend, and we shall speak again on next Monday. Thank you.